Good morning, dear guests and colleagues and everyone watching us online. It is my pleasure to welcome you to this public lecture at Eesti Pank dedicated to the memory of Professor Ragnar Nurkse and to the panel discussion with governors of central banks from Finland, Latvia, Lithuania and Estonia that will follow the lecture. We initiated the Ragnar Nurkse lecture series in 2007 to commemorate the achievements of the Estonian economist Ragnar Nurkse, who is considered to be one of the founding fathers of classical development economics. His works from the 1940s and 1950s are still cited in discussion of economics in Estonia and abroad. The idea of the lecture series is to focus on economic policy-related topics that are highly relevant to our region, and we always look to invite speakers of the highest caliber to address the Estonian audience. This goal, I believe, certainly has been achieved today, as we will have the opportunity to listen to first a speech by Professor Isabel Schnabel, followed by a discussion in which we will also have the possibility to hear the views of central bank governors from our region as panelists. There will also be a possibility for you to ask questions as part of that discussion. But now allow me to say just a few words to introduce our main speaker today. Isabel Schnabel is a German economist and a member of both the executive board and the interest rate setting governing council of the European Central Bank. Her main responsibilities at the ECB have to do with operations of financial markets, economic research, but also the implementation of monetary policy. Implementation of monetary policy that is central bankers' language about how we make sure that the changes in central bank interest rates and our other policy decisions really feed through the financial system with intended effect. Not only does Isabel hold an influential position at the ECB, but she also has had a distinguished academic career, as she has held various academic positions at the University of Mannheim, Harvard University, the University of Mainz, and the Max Planck Institute for Research on Collective Goods. She is also a professor of financial economics at the University of Bonn and has been a member of the German Council of Economic Experts, providing independent advice on economic policy issues to the German government. Her lecture will focus on the outlook for inflation in the euro area and what we still should look out for, as inflation has already moderated substantially since late 2022, but still is not yet at the central bank's target of 2%. So now it is my pleasure to invite Isabel to deliver her speech today as part of the lecture series. Isabel, the podium is yours.
Thank you very much, dear Maris, for the kind introduction. Dear colleagues from the Governing Council, ladies and gentlemen, it's a great pleasure for me to speak here today. It is actually my first time in the beautiful city of Tallinn, and I would like to thank you, Madis, for giving me the honor of delivering this year's lecture dedicated to the memory of Ragnar Nurkse, and for putting together such a great panel with many esteemed members of the Governing Council. Ragnar Nurkse is known for his contributions to the theory of economic development and international finance. But he was also concerned with inflation and the way monetary and financial conditions affect prices and wages. In my remarks this morning, I would like to explore the challenges monetary policy is facing today. And after the largest inflation shock in decades, disinflation in the euro area has proceeded rapidly. headline inflation fell from a peak of 10.6% in October 2022 to 2.6% in July of this year. Data released yesterday and today suggest that in August, inflation has declined further in parts of the euro area, and we are all awaiting the flash estimate for the euro area later today, which is likely to point in the same direction. These are welcome developments. They largely reflect an unwinding of the forces that over the past 3 years have led to strong increases in the prices of energy, food, and goods, as well as the impact of our restrictive monetary policy. However, the current level of headline inflation understates the challenges monetary policy is still facing. In particular, domestic inflation remains high at 4.4%, largely reflecting persistent price pressures in the services sector, where disinflation has effectively stalled since last November. The left-hand chart of my first slide shows that while goods inflation, shown in blue, has fallen back to its pre-pandemic average at a fast pace, services inflation, shown in yellow, is still more than twice as high as its average between 1999 and 2019. The right-hand chart shows that, as a result, services have accounted, on average, for 70% of headline inflation since the start of the year. My next slide illustrates that within the services sector, price pressures are broad-based, with strong wage growth being just one factor keeping inflation at elevated levels. As you can see on the right-hand side, stubbornly high price pressures in the services sector are a global phenomenon. Across many advanced economies, services inflation remains high, even if there has been, on average, more progress towards pre-pandemic levels than in the euro area. My next slide shows that inflation momentum in the services sector, defined as the annualized 3-month change, remains high, with services prices currently rising at a pace of almost 5%. Medium-term price stability does not require services inflation to slow to 2%. The right-hand chart shows that persistent relative price changes, often reflecting sectoral differences in productivity growth, are not unusual. In many advanced economies, the prices of services relative to those of goods have increased for a long time. But for price stability to be restored sustainably, services inflation needs to return to a level that is consistent with underlying inflation of 2% over the medium term. To assess whether the current monetary and financial conditions will secure a timely return of inflation to target, policymakers need to take a stand on the likely future evolution of the economy. Incoming data offer useful clues in this regard. But since monetary policy affects the economy with long and variable lags, there is a risk that policy might be adjusted too slowly if too much weight is given to backward-looking data. Therefore, economic projections remain a key input into our decision-making process. In the euro area, the latest Eurosystem staff projections are consistent with the return to price stability. They predict that inflation will fall to 2.2% in 2025 and to 1.9% in 2026, even if the last mile of disinflation is expected to be bumpy, with inflation likely to fall in the coming month before rising again towards the end of the year. Under strict inflation forecast targeting, policy should be adjusted to validate the financial conditions on which this outlook relies. However, inflation forecast targeting was already a challenge even in more tranquil times when shocks to inflation and its drivers were less pervasive. My next slide shows that since 2001, inflation projections from the forecasting community, including the ECB, have on average had little explanatory power for realized inflation over horizons beyond the very short term. In most cases, these forecasts almost mechanically converge to the 2% target unless judgment is applied. Managing inflation is particularly challenging in an era of transformation. We are seeing fundamental changes in labor and energy markets and a reorganization of global supply chains. At the same time, due to structural headwinds in some euro area economies, it is increasingly difficult to identify the impact of monetary policy on growth and inflation. And these forces make it inherently more complex to produce accurate projections even over shorter horizons. While short-term forecast errors for inflation have generally come down since the start of the year, this masks differences within the HICP basket. In particular, recent improved forecast accuracy for core inflation reflects offsetting forecast errors for goods and services. Since January, disinflation in services has consistently been slower than anticipated. In this environment, policy should be robust to contingencies causing the economy to evolve differently from what is implied by the modal outlook. Monetary policy that would be optimal under strict inflation forecast targeting can be suboptimal when knowledge is imperfect. Scenario analysis is a powerful tool for making policy more robust while retaining a forward-looking perspective. Plausible alternative scenarios that scrutinize the key assumptions underlying the modal outlook highlight the large uncertainty surrounding the baseline scenario. If this uncertainty is communicated clearly and transparently, the distribution of future expected policy outcomes may better reflect the risks to the modal outlook. Inevitably, policy cannot be robust to all contingencies. A policy that is robust to downside risks is unlikely to be equally resilient against upside risks and vice versa. Central banks thus need to weigh the risks and focus on those considered to be the most detrimental to the achievement of their mandate. In the current environment, monetary policy should remain focused on bringing inflation back to target in a timely manner for three main reasons. First, while risks to growth have increased, a soft landing still looks more likely than a recession. In recent weeks, financial markets have repriced more fundamentally the expected pace of central bank easing also in the euro area. This reflects concerns that global growth is at risk of a rapid deterioration. While growth prospects warrant close scrutiny in the coming weeks, the market repricing reflects, by and large, spillovers from abroad that were amplified by technical factors, including reduced liquidity during the summer period and the unwinding of yen carry trades. It is therefore unclear to what extent the repricing reflects a change in macroeconomic fundamentals. Indeed, my next slide shows that growth forecasts for major economies by market analysts have remained relatively stable. At the ECB too, growth projections for the euro area for 2024 and 2025 have remained broadly stable since September 2023. While monetary policy has to avoid unnecessary pain, it must also avoid overreacting to volatile financial market expectations. Central banks' actions should be guided by the evolving assessment of the inflation and growth outlook. Second, history shows that central banks were often unsuccessful in bringing inflation back to target after a long period of very high inflation. In their new research, Christina and David Romer show that perseverance is critical for successfully restoring price stability after a large inflation shock. They demonstrate that strong perceived commitment to disinflation has often not been sufficient to reduce inflation through its impact on expected inflation. Rather, successful disinflation was typically the result of policymakers having persisted in their efforts to fully extinguish past inflationary shocks. Hence, central banks must not abandon disinflationary policies too early. In the euro area, as we gained confidence in the projected disinflation path, we decided to start dialing back the degree of policy restraint earlier than central banks in other advanced economies. But the earlier monetary policy shifts in response to forward-looking signals, the more cautious and gradual it can afford to be on the way back to an unknown neutral. Third, even if inflation is no longer a primary concern to financial markets, it is still very much on people's minds. Although headline inflation has come down quickly, inflation perceptions are proving more persistent and untypically so from a historical perspective. The left-hand chart of my next slide shows that today, more than 40% of people still regard inflation as having risen a lot over the past 12 months. Elevated inflation perceptions raise inflation persistence and make inflation expectations more susceptible to new shocks, as memory cues make people recall past inflation experiences more rapidly. In a new study, economists at the Federal Reserve Board quantify these risks. They show that inflation persistence has increased measurably across advanced economies, including the euro area. As a result, if today the euro area were to be hit by a normal supply shock, as opposed to the unusually large shocks of the past few years, inflation would be higher by almost 1 percentage point next year, compared with a scenario where inflation persistence is lower. The right-hand chart shows that this risk is also reflected in the right tail of inflation expectations distribution remaining thicker than before the pandemic, even among professional forecasters. Making policy robust to these risks requires a thorough review of the main assumptions underlying the baseline scenario for policy to be adjusted. Such a broad-based review is carried out every 3 months when the projections are updated. In the euro area, the expected decline in headline inflation to the 2% target by the end of 2025 rests on 3 critical assumptions. One is that the current high growth in unit labor costs predominantly reflects the lagged effects of past price shocks related to the pandemic and Russia's invasion of Ukraine. As many wage contracts are only infrequently negotiated, the economy can take some time to return to equilibrium. The recent sharp decline in headline inflation should therefore progressively lead to lower wage growth. This would be consistent with staff analysis that you can see on this slide. According to this analysis, current wage growth reflects, by and large, past inflation. Unit labor cost growth is expected to slow further once the adverse impact of labor hoarding on productivity growth reverses as demand recovers. The second assumption is that firms are absorbing a large part of the current strong increases in unit labor costs in their profit margins, as the current level of interest rates is dampening the growth in aggregate demand. And the third assumption is that price pressures outside the services sector will ease further or evolve in line with historical regularities. Over recent weeks, incoming data have lent support to these assumptions. Negotiated wage growth slowed visibly in the second quarter. Although part of this development is driven by volatile one-off payments, with wage growth expected to re-accelerate in the third quarter, the right-hand chart shows that surveys and private sector forecasts suggest that expected wage increases will moderate measurably in 2025 and beyond. Firms also expect that increases in their selling prices will decline as growth in input costs slows. As you can see on this slide, according to the most recent survey on access to finance of enterprises, selling prices are expected to increase by 3% on average over the next 12 months, down from 4.5% at the end of last year. While firms in the services sector still expect a larger increase in their selling prices compared with other sectors, the size of intended price increases is declining there as well. Firms have also started to use their margins to absorb the increases in labor costs. The right-hand chart illustrates that in the first quarter of this year, unit profits no longer contributed to inflation in a meaningful way. This is a significant change from last year. Monetary policy is actively supporting this rebalancing process. By constraining growth in aggregate demand, it makes it more difficult for firms to pass on higher costs to consumers. Surveys suggest that the current level of interest rates is incentivizing people to save more and spend less. Notably, this slide shows that savings intentions for the coming year have never been higher than they are today, with households actively shifting their savings into time deposits offering higher returns, as you can see on the right-hand side. As consumer confidence is recovering and households' unemployment expectations remain subdued, it is likely that the desire to save is not driven by precautionary motives only. Finally, energy and food inflation have recently surprised to the downside, while a stronger euro, coupled with a recent fall in oil prices, can ease headline inflation further, at least over the near term. All in all, recent data remain consistent with the baseline scenario that foresees that inflation will sustainably fall back to our 2% target by the end of 2025. Along with signs of a potential decline in economic momentum in other parts of the world, there is less risk that a further moderate and gradual dialing back of policy restraint could derail the path back to price stability. It is conceivable, however, that the conditions on which the model outlook rests do not materialize. Scenario analysis can reveal the reasoning behind these risks and evaluate their consequences for the inflation outlook. In the alternative scenario, growth in unit labor costs would not come down as quickly as projected. In the June Eurosystem staff projections, annual growth in unit labor costs is expected to fall to 2.5% in 2025 from 4.7% this year. This is a sharp decline, especially as unit labor costs were still growing at an annual rate of 5.3% in the first quarter, with momentum remaining high. By way of comparison, annual unit labor cost growth in the United States was only 0.9% in the second quarter. Growth in unit labor costs could disappoint expectations because of stronger wage growth. Although surveys suggest weaker wage growth ahead, the staggered nature of wage negotiations implies that workers may take longer than projected to recoup their purchasing power. This slide shows that while in some countries, like Portugal, shown in red, and Spain, shown in green, workers have on average recouped the losses incurred in their real wages since before the pandemic. There's still a considerable share of workers in Italy, Germany, Finland, and other countries whose real wages remain well below pre-pandemic levels. This also reflects differences in the duration of collective wage agreements. Wages could also expand more strongly if labor market conditions remain tight. A protracted imbalance between labor supply and demand could more fundamentally challenge the assumption underlying the Eurosystem staff projections that wage growth merely reflects past price shocks and the resulting catch-up process. This slide shows that while labor demand is slowing, it remains high in an environment in which unemployment is historically low and where a significant share of firms, especially in the services sector, still regards labor as a factor limiting business, as shown on the right-hand side. If a shortage of labor prevents firms from increasing production, rising demand results in higher inflation rather than higher output. Another reason why unit labor cost growth could remain higher than projected is a weaker recovery in productivity growth. In the Eurosystem projections, annual productivity growth is forecast to recover to 1% in 2025 and 1.1% in 2026, nearly double the historical average. The pickup in productivity growth may be weaker if part of the current weakness is not cyclical, but more persistent, reflecting the structural challenges facing the euro area economy. In fact, over the past year, the recovery in productivity growth has repeatedly been slower than expected. Increasing trade tensions, environmental policies, or higher energy prices could all weigh on productivity growth over the coming years, reinforcing upward pressure on the growth of unit labor costs and thus inflation. In addition, under the alternative scenario, firms may decide to pass on a higher than expected share of rising labor costs to consumers. The Eurosystem staff projections expect unit profits to stagnate this year as firms use their margins to absorb strong growth in input costs. The buffer provided by profit margins is particularly important in the services sector, which is more labor intensive and where inflation is still high. New evidence for the euro area suggests, however, that the pass-through of higher wages into producer prices is typically very strong in the services sector. As you can see on this slide, after 2.5 years, the estimated pass-through is 86%, shown in red for services, twice as high as in the manufacturing sector, shown in yellow. In other words, if the pass-through in earlier stages of the pricing chain remains as in the past, there needs to be a strong decline in profit margins for the baseline to materialize. Softening demand for services as part of a rotation back to goods could be one such factor. As this slide shows, however, so far demand for services has remained relatively resilient, even if there are signs of a weakening. Looking ahead, it will be critical to observe how the interplay of rising real wages, a resilient labor market, and the fading impact of monetary policy tightening will contribute to aggregate demand. In particular, as you can see on this slide, the most recent bank lending survey suggests that the economy is starting to adapt to higher interest rates. Banks reported a first increase in loan demand by households in 2 years, while loan demand by firms is still contracting, but at a more moderate pace. Finally, price pressures outside the services sector may reappear. Goods inflation is a case in point. Under the baseline scenario, it is expected to remain close to current levels as the disinflationary effect of the easing and supply chain disruptions fades. At the same time, protectionism and geopolitical uncertainty are rising. According to the Peace Research Institute Oslo, the number of state-based conflicts is the highest since 1946. Geopolitical uncertainty is a key risk for the stability of global supply chains and commodity prices. As my slide shows, recently container freight rates have increased measurably, in part reflecting disruptions in the Suez Canal. A further escalation in the Middle East could disrupt energy markets and supply chains more fundamentally. Global trade measures are increasing in parallel, and this is shown on my final slide. Trade measures are increasing especially for critical raw materials, the production of which is often concentrated in just a few countries. Together with the growing impact of climate change on food prices, these are important forces that could challenge the assumptions underlying the baseline scenario. I would like to conclude with 3 implications for monetary policy. First, incoming data have broadly confirmed the baseline outlook, bolstering our confidence that conditions remain in place for inflation to fall back to our 2% target by the end of 2025. Second, confidence is not knowledge. History will not judge our intentions, but our success in delivering on our mandate. Given that the path back to price stability hinges on a set of critical assumptions, policy should proceed gradually and cautiously. In particular, the closer policy rates get to the upper band of estimates of the neutral rate of interest, that is, the less certain we are how restrictive our policy is, the more cautious we should be to avoid that policy itself becomes a factor slowing down disinflation. In other words, the pace of policy easing cannot be mechanical. It needs to rest on data and analysis. Third, the world around us is changing rapidly. When the future is as uncertain as it is today, the modal outlook provides a false sense of comfort. Scenario analysis can protect us from falling victim to model uncertainty and overconfidence. Being transparent about what could go wrong and factoring this into the decision-making process can help make policy more robust to contingencies that threaten the achievement of our primary mandate. Thank you very much.
Thank you very much, Isabel. It was an excellent summary of where we stand and also an overview of the risks that we need to look out for also as we expect inflation to gradually come down to 2% by the end of next year. But now, let's proceed with the panel discussion, and I would like to invite also my colleagues, governors from Soome Panki, Olli Rehn, from Central Bank of Latvia, Martins Kazaks, and Lithuania, Gediminas, to join us. So the idea is that we will have a bit of a panel discussion. I will be moderating it and also maybe providing some comments of my own. And then by the end of it, there will be also time for the audience to ask some questions. So the focus of the discussion will be what we have learned for monetary policy from the last 10 years or so. We have lived through a number of crises, starting with the pandemic, the energy crisis, now the war in Ukraine, the impact that has had on the economy in Europe and also central banking. So it has been a turbulent time for the euro area economy as a whole, but it also has certainly been a challenging time for us as central bankers. So I'm sure there's a lot to discuss around those issues. Perhaps we could start with the question on inflation. You had, Isabel, a nice chart showing how for the euro area as a whole, inflation peaked at more than 10% in the fall of 2020. In fact, in Estonia and also in Latvia and Lithuania, we had even inflation rates at more than double of that, going beyond 20%. So the question is how much of an issue it really is the divergence of inflation rates in different countries of the monetary union of the euro area. Is that something that we as central bankers setting monetary policy for the euro area as a whole should be concerned about, or is that to be expected? So I think that's something that's maybe worth discussing. Who wants to start? Isabel, maybe
yes,
it naturally follows from the presentation.
I'm happy to start, and then of course my colleagues can add. So, I mean, you described it very well. We've seen a lot of divergence, especially after the Russian invasion of Ukraine. And if we look at the reasons for the divergence, actually energy prices played a very large role. So, for example, the Baltic countries, which suffered from particularly high inflation, they have a relatively high energy share in production. There's also a very high share of energy and also food in the consumption basket. There was, of course, relatively high dependence on Russian energy. And also these are economies that are very closely connected to global supply chains. And so we saw these really massive divergences. But in order to judge whether that is a problem, I mean, it's always a problem, or maybe we can discuss it also, it's always a problem for the country itself. I mean, it can be a problem for the country itself. But for monetary policy in a currency union, what really matters is whether this divergence is transitory or persistent. And unfortunately, what we have seen is that even though, I mean, we had this huge divergence, it actually by now, it has to a large extent normalized. And so for the single monetary policy, this is very good news. So if such a divergence was more persistent, I mean, this would cause serious issues for monetary policy because it would be very hard for the single monetary policies to stabilize euro area-wide inflation. But then again, monetary policy would not have the tools to deal with such a persistent divergence, but that would need to be dealt with by governments, by structural policies.
Right, thank you, Isabel. I think all of us would like to comment. Gediminas was first to raise the hand, please.
Okay, thank you very much. And actually, my answer is very much aligned to what Isabel has said. So we should clearly separate long-term and short-term. And in the long term, so what really matters in the differences in inflation among 20 separate euro area countries, of which have different wage setting mechanisms, which have different economic structure, which have different fiscal and social policies, and we shouldn't be, so to say, naive. We're going to have some differences among the inflation rates. For instance, the Baltics, or at least in Lithuania, we have had inflation in the last 10 years, before the pre-COVID time, 1%, around 3%. So it's already 1 percentage point higher than the inflation target, and even more higher than the actual inflation in the euro area as such. But is this a problem? I wouldn't say this, because we are catching up economy. So that's, in a way, comes from the structural factors. Very different story is about this recent inflation period, when you mentioned already that we had more than 20%, while the euro area was 10% inflation on average at the peak. But here, what also matters, it's not only or what have mattered, not only the, so to say, openness or exposure to the external shocks, such as energy shocks, but also fiscal response. So in many countries, there were fiscal measures that were intended to diminish the inflation. So for instance, decrease of VAT or some other measures while in Lithuania, the authorities focus on keeping up the income of people, in a way resulting in the same or working in the same way and has to help people to cover the increased expenses, but with a different effect on the inflation itself.
Mm-hmm. Right. Martins, please.
I by and large agree. But I think a couple of smaller points on this one as well but before I do that, thanks a lot for the invitation. It's a great event, and I have a true pleasure of being here. And I agree with your introductory points very much. So I hope we'll get back to the inflation forecasts and all these kind of things as well in this discussion. But about the different inflation rates, of course, the nature of the shock and very much the energy and closeness to Russia was important for the Baltics to be more vulnerable. Okay? But there's yet another element, the way this shock is being transmitted, so the transmission mechanisms. And what we see in the Baltics, that many of those are much, much quicker than in other European economies. For instance, administratively regulated prices that very much depend upon energy. In the Latvian case, they by default are reset twice a year. So the external shock travels into the economy very quickly. There are countries where the fixed prices time scale is years, not months. Okay, so that makes us different as well. But of course, also when energy prices come down, it gets priced out much quicker as well, and that's why the volatility in the Baltic economies for inflation has been very, very stark. Let me add one more thing. Of course, the time scale is important. Is it temporary? Is it permanent? If it is permanent, at the end of the day, it will cause problems. And that's why I think the fiscal policies are extremely important. How do they react? But I would say much more in terms of also structural policies. If European economy, if Euro area economy becomes much more aligned in its structure and its business cycle is increasingly aligned, then the shocks that will hit us are going to be much more symmetric across the Euro area. And then it would make life somewhat easier for monetary policy. But at the end of the day, it is also about structural policies. Okay? You cannot rely only on monetary policy to ensure that inflation is going to be around the target for all of us.
Right.
But so far, so good.
So far, so good. Olli, you want to add something?
Thank you, and thanks for the invitation. It's great to be back in Tallinn and Estonia. It's not precisely my first time here. I recall my first time was in fact in 1982, after I had completed my military service and the reserve officer school. My old man and I made a father-son trip to Tallinn and actually to Riga, Latvia as well, and that's forever in my memory, and I have that's where my first friendships in these countries date from. I was an active political tourist here in the 1980s and early 1990s as well. As regards the energy price shock, which is the key reason for divergence we have seen in inflation rates in the euro area, the root cause is the direction of the sun. South is there, so the root cause is there. It's in the Kremlin in Moscow, and it was caused by Russia's illegal, brutal attack in Ukraine. And it's really appreciated that you have a Ukrainian flag here with the European and Estonian flags. Ukraine is fighting for freedom, democracy, and for Europe. I would agree with the colleagues that you have to keep in mind the timeline. It's a supply shock in economic terms, and you have to see that it takes some time before it fades away. And in our case, if you look at the euro area as a whole, normally we spend around 2 to 3% on imported energy. During 2022-23, we spent 6 to 7% And this difference of around 3 percentage points is the extra tax European consumers had to pay for energy. And of course it was taxed, but there was no revenue, so it cut our living standards by this 3%. Now we are, in a way, thanks to adjustment in energy policy, we are back at around 3% for the moment. In our case, in Finland, we faced less dramatic shock, even though inflation was high also in Finland, mainly because of the energy mix, as we have a high proportion of nuclear energy, and almost half of energy is produced by renewables, so this worked as a buffer in terms of receiving this shock. One more thing I want to say is that while it's important to look at divergence, so we have to look at the euro area, the eurozone as a whole, and as regards inflation, or in recent 2 years disinflation, we have to see the forest from the trees, as Isabel clearly maintained. We've seen a very strong disinflationary process from 10.5% to 2.5%, and this is very critical. Disinflation is on track, and we have to, of course, monitor that very closely. Second factor is that the growth outlook is weaker than expected, especially because manufacturing in Germany is showing almost chronic recession, and that's more widespread also in the eurozone, and there are risks to the downside to our growth outlook. So disinflation is in the process. At the same time, growth outlook is more subdued. In my eyes, this reinforces the case for a rate cut in September. And that's how I see the monetary policy stance in light of all this data and analysis we have for the moment.
Thank you very much for all your comments. I think we view the issue really in a similar way when it comes to divergence of interest rates in member states of the euro area. Indeed, it matters if it's a temporary or a permanent situation. I think it's also quite natural if we have different consumer baskets that interest rates, inflation rates can vary. But I think you made some important points. For example, Gediminas on the role of the government and the fiscal policy that can also, in a similar situation, even perhaps be quite different in different countries. And that's something, of course, that is beyond the central bank's control. But a related issue, as it is the fact that we have had very different rates of inflation, it also means that there are different cost pressures for companies and also exporting firms in different countries. It does have an implication to the competitiveness of the firms and the economies of different member states. I think one can also discuss the competitiveness of the euro area as a whole and comparing to other regions. So I wonder if that's something you have thought about or have particular comments on. So maybe Isabel on the euro area.
I start with the euro area, and then you can give your individual perspectives. So, I mean, we are seeing that competitiveness is very much nowadays on the political agenda. So Brussels is talking about competitiveness all the time, and there's of course a reason for that, which is that the euro area as a whole has lost competitiveness, and that is not just over the past few years, but over even a longer period. So if we look at like export market shares, we see that they have trended down over many years now. Of course, I mean, this is partly natural because there were new economies that were integrated into the world economy, especially China, of course. And so it's natural that there is a certain decline. But the decline is actually quite strong, and it has accelerated over the past few years. So it seems that the recent shocks have mattered a lot for competitiveness. I think it's very insightful to just look at the real exchange rate of the euro against China. And there you see that we've had a massive real appreciation towards China. And this means there is an erosion of competitiveness. There's a very interesting analysis that has been done recently within the ECB, which looks at the drivers of this loss of competitiveness. And there's one thing that comes out very clearly. The key factor for this decline of competitiveness over the past few years is energy. So if you look at what happened to exports, it's almost entirely driven, I mean, not in the early parts of the pandemic, which is a different story, but after that, it's almost entirely driven by energy-intensive industries. So it seems that in order to deal with the competitiveness issue, it's absolutely crucial to think about what to do with energy. And I mean, remember that energy prices are not back to where they were. But we also see that different energy mixes, for example, I mean, they matter a lot, as you mentioned, yes, Olli. And so this is something that I think Europe really has to think about.
Mm-hmm. Yes, Olli and then Martins.
I think it's important to distinguish between the two elements of competitiveness. I did my PhD at Oxford on a subject industrial competitiveness of small European states. But I saved you from a lecture on this. I give you a snapshot or nutshell of it. One factor is real or structural competitiveness that's translated into productivity in economics terms. The other side is the price of labor, and both of these elements, so price of labor, i.e. cost competitiveness, and both of these play a role. And for instance, in the case of Finland, we have, after a long period of catching up, especially after the Second World War, up until 2000s, basically, we have seen a period of slower productivity growth. At the same time, our competitiveness has been quite stable in the past 10 years, mainly because wage growth has been quite moderate, as you could see from Isabel's slides earlier on today. So the equation has been kept at a level where overall competitiveness is sort of okay, but not for the right reason, because I would very much prefer that we would have a higher productivity growth, which would create space for higher real wage increases. And that's very much the case for most of Europe. And that's why we have to engage in such reforms of the single market, of the labor markets, as well as improve our financial markets so that we can better channel savings to investments in Europe, to startups and to growth companies. So this is really a challenge for the whole European Union, for the governments, for businesses, and I really hope that, and I trust that the main objective, the key objective of the new European Commission that will be set up soon will be how to tackle this challenge of industrial competitiveness of Europe.
Thank you. Martin.
Yeah, Europe is clearly in lack of competitiveness, and I would even say that, unfortunately, there are no good news in a way. Monetary policy has, I think, done a very good job in terms of ensuring that we're back, and I hope we will get to the target quite soon as well. But overall, this very heated episode of extremely high inflation is behind us. So we're back to more normal levels of inflation that provide more stability and provide basis for growth. And we've seen that the new business cycle kind of has started, but it's still very weak, it's timid, it's patchy. One quarter is better, the other one is weaker, and all these kind of things. So there's no oomph, there is no this strong recovery. And of course, to a large extent, this is a structural story, and there is no way around it. Even if monetary policy will maintain inflation at 2%, if there is no improvement in the structure of the economy, then growth will not be there. And if there is no growth, of course, at one point, political economy is at risk of becoming even more populist. Okay, so it's not a stable equilibrium. We need more growth. Europe is in bad need of stronger growth. And let me mention a couple of elements that worry me. And Olli and Isabel gave the European view. Let me provide a bit more of the Baltic view, and in this case, the Latvian view. What happens in the Latvian economy? As I said, the new business cycle has started, but it is quite patchy and volatile. And there is an important thing, how do other policies react? Because monetary policy is straightforward in a way. We will aim towards 2%. Okay, 2% symmetric, and I think this target is very appropriate, easy to understand, and improves the credibility of monetary policy, and also the inflationary expectations are strengthened. Okay? But fiscal, for instance, in the Latvian case, what we do see is that wage growth is still very strong. And by the way, if we take a look at the Baltics overall, wage growth over the last 5, 6, 7 years in the neighborhood of 10%, what kind of competitiveness are you talking about? You're building up risks if productivity is not catching up quickly. And I have never seen productivity catching up that long at 10% rate every year. So we are building risks. That is very clear. To reduce those risks, we need to, again, go back to much stronger productivity growth. But there are, of course, hurdles along the way. And one thing that I see, for instance, currently in the Latvian economy is that since late last year, the key driver of growth of wages is the public sector. Okay? So the private sector starts to slow down the speed of wage growth because of the competitiveness issues. Okay? But the public sector is still kind of driving the inertia, and that could become problematic. So my government is looking into this, thanks God, if I may say so, how to align those wage growth and competitiveness issues. Okay? So public sector should not become the driver of wage growth and exaggerate those competitiveness problems going forward. Okay? So that is politically difficult, but unfortunately we will need to do it. Point two, as for the structural issues, of course energy is extremely important, but it's also the financial market's ability to transmit funds to the businesses, and Olli's point of capital markets union is a very stark example of that. But let's take a look at the kind of financial balances of our economies. If I take a look at the Latvian economy, then loans to deposits are close to 70%. So it's not really the lack of money. Okay? It is the problem how this money gets transmitted to the businesses. So the financial system needs to become much more effective. In Estonian case, loans to GDP are at just above 60%. In the Latvian and Lithuanian situation, that's a much bigger problem. We're in the neighborhood of 30%, a bit better in Lithuania, a bit worse in Latvia. So there are ample opportunities where the financial sector needs to, the private financial sector, banks, non-banks, need to do their job in a more efficient way. And also the third point that I would very much mention is the confidence. And this is the confidence of businesses, that businesses really strive for growth. They want to grow. Okay? Yes, there is the chill from the east, okay? But this time we are on the right side of the fence. Okay? We are part of NATO, and Olli, I'm extremely happy to see you joining us, because Finland, of course, joined NATO as well. So it makes us stronger. Okay? So our strength to grow our economies is to become more productive. And that's the best way for us to remain independent and resilient against the risks from the East. So we will just need to pull ourselves together. Don't be that much afraid of those risks. We need to be more confident. We need to invest. We cannot sit it through, okay? We just need to run ahead. Thank you.
Thank you. I sense there's some confidence that we can pull ourselves together.
Of course,
yes.
And we've done it. We've done it in the 90s, we've done it in 2000s, so why not now? Okay? Yes, and that's an interesting element as well, is that, of course, there is, somebody does better, but we learn from each other, and I think that's a very important thing to learn. 10 years ago, Estonia was kind of a poster child and the success story of the Baltics. Now it's Lithuania, and I hope that in 10 years it's going to be Latvia, because it's going to make all of us stronger and more resilient, and our society is more affluent. There is no other way. So,
what's the secret of Lithuania?
Yeah.
Well, whenever I get this kind of question, as Lithuanian, I start thinking, is that really how Lithuania looks like from aside? Because when you are in Lithuania, you see many troubles, issues, and problems. But thank you.
You're welcome.
Thank you. Talking about Lithuania, okay, we project this year to grow 2%, next year 3%. It's not miraculous. But it's way better than if you understand that Estonia's economy is projected to shrink this year, as far as I know. And I think, as everywhere, you start building the roof in summer, not in winter, and that's, I think, what has happened in Lithuania. So largely, the last 2 years, our economy was sluggish, and people are not happy. But as I said, when you start building roof in summer, so I think in a way, what we call as a success now, it started in 2020. It sounds unbelievable because this is the year when COVID hit, but actually this is true because somehow, I think it's also in Lithuanian entrepreneurship. Typically, when you read this about in the textbook, you don't take it serious, but I think it really exists because somehow my country, and businessmen of Lithuania, managed to make use of any crisis. Was it 1999 Russian crisis? Was it global recession? Was it 2014 Russian sanctions and anti-sanctions? All these occasions were used by Lithuanian businesses and the same COVID. So when the COVID hit, what has changed? So our manufacturing actually started growing substantially, while the European countries, our Baltic neighbors, were fluctuating more or less around the same levels. Manufacturing in Lithuania was growing. Why? Pharmaceutical sector, transport sector. So we just took the markets that were so to say maybe left alone, and I think this helped a lot now. This helped a lot to build a potential, which was when used in the later years, and when Russia started this full-scale invasion into Ukraine, and the energy prices hit, and as we already talked, yes, our manufacturers were affected very heavily, but on the other hand, we fell from the levels that were already far above the levels of in comparison to our country. So this is one thing. The other thing is that Martin mentioned wages and public sector, private sector. Well, and I be surprised yesterday our colleagues from Finland telling that in Lithuania we regulate the minimum wage. So in many countries we don't have it. We ask, what is the minimum wage? Why do you say that? But what I think in this regard is that it very much depends who drives what and at what levels the things are. So when you talked, Martin, about the public wages and that we shouldn't affect the, so to say, the overall growth of wages in the country, I would ask you a bit differently. Are people from the private sector moving to the public sector? If they don't, so kind of likely that the people in public sector are not well paid, And I would say so there is such a saying, we don't have a luxury to have underpaid public workers. Why? Because it's very important that we do a great job. Otherwise, you'll have even bigger problems. But we regulate minimum wages, and we see it as in a country, the government, and we see it as a certain measure to reduce the social inequality. But overall, wages are growing very fast. And together with the decline in inflation, prospects of a lower interest rates, hopefully, lower interest rates, and actually inflow of a labor force, which so to say eased the pressure on the shortage in the shortage of a labor force. This fueled the domestic demand. And the other fact that I think it's also very attributable to Lithuania as such, so how much of the labor force we imported. Yes, so there were Ukrainians, refugees, they came into many European countries. But in terms of the population, I think Lithuania was the country that took proportionally the biggest share. So around 70%, 70,000 of Ukrainians came into the country, but not only. Also Belarusians and to some extent Russians. But Belarusians, they were economic migrants, but also economic migrants coming to the country together with their businesses, IT businesses. So they came to the country not only asking for jobs, but actually bringing the working place and thus adding to the economic growth. So we don't have the recent figures, but in 2022, I can refer to my colleagues, but we estimated that in 2022, the inflow of Ukrainians built or helped to lift up Lithuanian economy by 1 percentage point of GDP. So it's again quite substantial. Mm-hmm. So domestic demand, and also investments. Investments by businesses, but also thanks to the EU various funds and recovery and resolution funds, and to some extent we say EU funds are like Marshall plans for the Baltics. So investments grew quite substantially too in the country. So basically these two factors are helping to recover or to Lithuanian economy to grow a bit faster than probably in some other Baltic countries.
Yeah, thank you, Gediminas. I'm glad you got into this because I was going to ask about how your economies are doing also, because it really matters also for Estonia, our neighbors being important trading partners. And if you are doing well, then we have a better outlook as well. But I think it's an interesting point, Gediminas, you made about foreigners coming to Lithuania, because it is indeed different in your case. It's not only in the last couple of years people from Ukraine, but also Belarus with their businesses. Exactly. And being eager to contribute, but also the confidence, indeed, the confidence of both businesses, entrepreneurs, and consumers is important. And this is something where there seems to be some divergence between our countries at the moment as well. But perhaps Martins and Olli, if you could comment on how Latvia is doing and Finland, and what the outlook in the short term is.
Before I do that, I think there is one other element which is extremely important when we take a look at the volatility of inflation. We saw very high increase in the Baltics for the reasons that we discussed, but what does that mean for monetary policy? And I think it very much strengthens the case for credible monetary policy, for trust in the central bank doing what it should be doing, and it anchors the inflationary expectations. Why? Because if you have such wild swings in inflation, then there is a very high risk of switching from low inflation regime to high inflation regime. And why is it important? Because low inflation regime is self-stabilizing. So it tends to come back to lower inflation levels. At the same time, of course, the high inflation regime becomes increasingly destabilizing. And this is what we saw also in the Baltics in terms of price switching behavior. We saw that in a way the switch was switched on very quickly, and the corporates started to reprice their prices much more often than in the past. So it's extremely important to pull inflation down back towards the area of low inflation regime which stabilizes itself and then provides basis for growth, okay, which then comes through demand and structural reasons and all these other issues. So I think that is very important, and as our colleague Andrew Bailey in Jackson Hole said, I think it's a very kind of clear statement, intuitive, but also in my view very true, is that inflation targeting regime is credible only because central banks exercise it. You know, they do act. And this is what we saw in the very sharp increase in the policy rates when inflation really shot up and we needed to bring it down very quickly. Of course, again, the transmission depends from country to country, and we can discuss it, and that's another important element in terms of inflationary dynamics. But coming back to the question that you asked on the Latvian economy fair, the new business cycle has started, the growth is patchy, quite weak, we are in bad need of productivity growth. But what are the key issues that are weighing down growth? Point one is weakness of our export partners. Okay. German economy is weak, Finnish economy is weak, Swedish economy is weak. Unfortunately also the Estonian economy is third year running, relatively weak. Okay. So, and they are our key trading partners. But the mindset is changing, and we see this year we will grow in the range of 1% or a bit more. We'll see. You know, we will have our forecast in September. Next year we'll pick up, hopefully towards 3%. So situation is relatively similar to what Gediminas was saying. But is 3% good? It's decent, but it's nothing really spectacular. We can and we should do much faster. Okay.
Olli, anything about Finland?
Yes, first comment on the inflation regime. I would agree very much with Martin's, and it's really essential that we realize how important the credibility of monetary policy and the central bank is to ensure that inflation stabilizes to the target following large supply-side shocks that we have faced in recent years. And here there is a critical difference between the recent period and situation 50 years ago or 40 years ago in the 1970s and early 80s, or say from the late 60s until early 1980s in the whole Western world, both in Europe and in the United States. All the Western advanced economies then faced a period of stagflation, that is galloping inflation and slow growth or negative growth and high unemployment. Now, we have not faced this kind of stagflation recently, and the key factor has been that the central banks are credible in their job in bringing down inflation to the target, stabilizing inflation to the target. And here, the critical difference to the 1970s is central bank independence. And that's why it is so important to cherish and ensure that this will be continued. And I hope that there will not be any setbacks to central bank's independence in the United States of America, for reasons which I don't have to mention here, because that would start spreading to Europe as well. So that's why the US presidential election is critical also for Europe and Europe's economic development over the longer term. Concerning Finland, we have both worse news and better news. The bad news is that we have this year suffered from slightly negative growth, and we see that that has been mainly the consequence of the recent crisis. For instance, one factor is that we lost Russia trade, which was about 5% after the annexation of Crimea. You may know that on average Finnish Soviet or Finnish-Russian trade had been in the scale of 10 to 15% of our foreign trade. Now it's virtually zero. So that's felt in some parts of the industry and in the regional economy of southeastern Finland. But the good news is that we have the lowest inflation in the Eurozone for the moment, around 1%. And as wages have been increasing rather moderately, but still increasing, so the real incomes of households, the real incomes of citizens have been increasing since last summer, 23. And this is supporting private consumption, this is supporting domestic demand, and that's carrying the economy forward in the short term. What is missing is, as Martin's already referred to, what is missing is stronger world markets. We are also suffering from the weak economy in Germany, weaker growth in China, and relatively weak growth in the rest of the Eurozone. The US economy is relatively strong, and that's good news for exports, of course. But we expect that also the exports will strengthen in the next 2 years, and our projection now for 25 and 26 is pretty much in line with the rest of the Eurozone. Finland is in many ways a microcosm of the Eurozone, and we are projecting growth of 1.5% for next year and the following year. So that's the overall picture of the Finnish economy in a snapshot. I add one thing, that's productivity growth. That's the challenge, and that calls for investment in research and innovation. That calls for further labor market reform, and that calls for better single market in Europe and better functioning savings and investment union in Europe.
Thank you. Isabel.
Yeah, I wanted to make a comment related to something that Olli said. So, I mean, first of all, one of the really good news we had over the past years was the resilience of the labor market. And I think many of us were very surprised about that. I mean, we had massive shocks, and we had a historically unprecedented hiking cycle, and still the labor market has remained resilient. I mean, basically all over the euro area. And I think, I mean, economists are still debating why is that? I think one point that we have to recognize is that the shocks that we had were partly buffered by fiscal policies. So governments did a lot to buffer the shocks. But of course, that also means that some of the risks have migrated from the economy to the public sector. And this shows up in rising public debt ratios overall, which, and this leads me to what Olli said, which can potentially become a threat also for central bank independence. And this is why it is absolutely crucial that we have an economic governance framework, a fiscal framework in the European Union that is credible and that is fully enforced, because in the end, that also protects our independence. And that's the point I wanted to add.
Mm-hmm. Yeah. Very much I agree on that, and not least because I was commissioner when we presented the six-pack and reformed the economic governance of the Eurozone. And I think, and I would agree with Isabel, that it was right that the governments acted with fiscal stimulus in March 2020. That was right, and we acted as the central bank very forcefully then. And thanks to this forceful monetary and fiscal stimulus, we avoided mass unemployment and wave of bankruptcies in Europe. But as we say back home, the doping continued for too long, or the choke or drinks continued for too long. So fiscal stimulus should have been stopped, say, latest 22, 23. But it continued, and that's why we in Finland, like in most Eurozone countries, we have too high public deficits, and that's why the EU fiscal rules are so important, and they should be applied effectively now in the coming autumn and coming years.
That is something we're working on as well in Estonia. But Martins, you wanted to add something?
Yeah, in a way it was already covered, but if I have a chance, I see the time is running out, so I will be disconnected very soon. So let me just add one more thing on the Latvian economy and one more thing on the independence. And as for the Latvian economy, of course, the external sector, but it's also the confidence, and that's why I early in today's discussion mentioned the confidence. Real wages have recovered. The wage growth has been very steep. Since mid last year, wage growth on average is faster than inflation, so this bite into the purchasing power from inflation, it's all done. Okay? Now what we see in terms of wage growth, all that is real growth in purchasing power. But households are quite cautious to spend. They still save up. Corporates as well. They do not aggressively invest. They kind of still stay relatively kind of cautious. So this confidence element is extremely important. And money is much more expensive now. So that means that time is much more expensive. Don't linger. Think about the opportunities of the business cycle, invest, and if it's necessary, consume. That will boost economic growth as well. Coming back to the independence, I think it is extremely critical for the central bank to maintain its institutional independence because it can do its own job when it's necessary. Okay, and our mandate and target is very clear, and that is helpful. But what does it mean for smaller open economies like ours? It means, of course, that the monetary policy is a single monetary policy for the whole of euro area. The business cycles are not that clearly aligned. The shock transmission is not that symmetric throughout the euro area as well. What does that mean? Of course, that we have one monetary policy, but multiple fiscal policies. So that is important to recognize that fiscal policy should be aligned with monetary policy, and this is monetary dominance, not fiscal dominance. Okay? But there is much more than that. There are many other policies that need to complement economic policy response at a time when, for instance, monetary policy is pushing inflation down. So it's a whole set of policy mixes. And we should not stick to just monetary policy saving everybody. It's simply impossible. It's also not sufficient with fiscal policy being responsible. There are also other policies without which there's not going to be growth. Okay, so.
You're certainly right about all that, Martins. And I think we're actually fine in terms of time because we have some extra time for questions still.
Good.
But before I'm turning to the audience, perhaps just to ask one more question from you. You mentioned it was, Isabel, impressive how the labor market has remained so strong in light of the really the record fast interest rate rises cycle that we concluded last September. Another thing that I think has been impressive is that also when you look at, for example, the non-performing loans and how smoothly the financial markets in a way took the very sharp increases in interest rates, as we indeed, during the time at the time when taking those decisions, certainly there were a lot of concerns about possible turbulence that we might see in the financial markets, also possible problems that borrowers might have with servicing their debts. We haven't seen that much of it really. So in a way, I guess it has been a sort of a successful test of how monetary policy, also when tightening, can be transmitted to the economy. But Isabel, was that sort of surprising to you, or how do you see these recent developments?
So first of all, I fully share your assessment that overall the transmission has been very smooth. And I would say that was slightly surprising that it went so smoothly, given the steepness of the hiking cycle. And I also remember very well that we had quite a few concerns at the time. And I would still say that was justified. Because it's not that we haven't seen any turbulences. We have seen some turbulences in sovereign debt markets. We have seen some turbulences in the banking sector. Fortunately, not in the euro area, but especially, of course, in the US. And I mean, we have to remember, I mean, we were coming out of a very long period of extremely low interest rates. Then we had this very fast hiking cycle, and that nobody had expected, including us. Mm-hmm. And so nobody was really well prepared for that. I mean, there was the general expectation that interest rates would stay low for a very, very, very long time, and then the opposite of that happened. And I think it was very right that we were concerned about this shift. I mean, we also, of course, because we were concerned, we introduced a new instrument, the Transmission Protection Instrument. I continue to believe that without that instrument, this steep hiking cycle would not have been possible. And I think it's a very well-designed tool that also aims to deal with issues like moral hazard and so on. But I think it is an important addition to our toolkit. Of course, it seems our banks were quite stable, which is also a success for all our supervisors, I would say, because that was obviously not the case in all places. But I must say I'm very happy, of course, that it went smoothly, but it was not a given at all.
Yes, I agree with you, and you have good arguments why it might have been so. I can see all of you want to comment also on that. I think Gediminas was the first to raise the hand.
Okay, thank you. Well, I think it was, yes, I agree, it was surprising. And I couldn't conclude the other way around, because to the unprecedented levels of inflation, the ECB and actually the other banks, central banks, reacted unprecedentedly in 15 months, 10 hikes by 4.5 percentage points, from minus, interest rates from minus to quite high levels in the positive territory. But more surprising for me is not the fact what was the effects of the monetary policy, because we can remember how many there were fears that the euro area economy will contract in recession, contraction, and etc. And it's actually it's slowed down, but it's sluggish, the economy. But it's not something that was, so to say, projected or feared some time ago. But for me, the most surprising thing is to what extent or by how much we have not evaluated the effects of various fiscal measures and their implications to the overall economic performance and actually onto the businesses in the future. So the fiscal support in 2020, 2021 was massive. And actually, I can't refer now to the euro area numbers, but I can refer to Lithuanians. So when the IMF Article 4 mission came, and they estimated the financial stance of businesses in Lithuania in 2022, they concluded that businesses are way stronger than in the pre-COVID time. So after all these 2 very difficult years, businesses accumulated reserves in terms of the non-distributed profits and etc. And also, the workplaces were also kept Isabel has already mentioned that life would have been different if labor markets were affected. And they actually enjoyed that. Yes, we are not happy that labor markets are tight and, this fuels the dynamics in wages, etc. But I tend to believe that this is the better state of the situation than we would have had if the economy was contracted, there was a sharp increase in unemployment, and we would have been reacting differently. So, all this long story short, I would say, yes, it's surprising. It's surprising. Yes, after this sharp hike of interest rates, there were expectations that we'll see more NPLs, but fiscal measures and how the economy in fact evolved and what was the strength of businesses, it helped a lot to cushion these implications.
Right. I think probably in our countries where we had most loan contracts with floating interest rates and the payments, loan repayments, monthly repayments increased even more than in many other parts of Europe. It probably also helped that the incomes grew so fast also for individuals who were then able to service their debts. But Martins, you want to add something to that?
I think Gediminas by and large covered it already, but of course I think one has to again I think we're again beating around the same bush, you know, in terms of fiscal. Fiscal at some point needs to step out, okay, and it should not linger on. And for this process to happen smoother, we need structural. So at the end of the day, if we don't see policymakers, and this time it is not monetary policy that very quickly moves in and is able to quickly move out, if we don't see other policymakers to chip in quickly, especially with structural improvements, then growth is going to linger on. And currently one of the big discussions in terms of the labor market resilience, and it has been very surprising, and the overall resilience of the European economy has been surprisingly strong, which is good news. Nobody wants a recession. Nobody wants high unemployment. But one of the stories is, of course, labor hoarding. Now, if that hypothesis is really true, okay, and there is no growth coming, then at some point, labor hoarding will switch off, okay, and then the world can change quite quickly. So I think even with this inflation episode behind us, even with growth gradually coming back, we are still not really on the safe ground. As for monetary policy, I fully agree with Isabel's storyline that we can ease up monetary policy when we see it step by step data dependent, but inflation in the services sector is still relatively sticky and high. So we cannot rush as well. So it's going to be a paced, in my view, decrease, data-driven, not data point-driven. And I'm open to the discussion in September, seeing what's the latest data. So fine, of course, we're not taking decision today. We will do that, you know, very shortly at the Governing Council. But we can afford to ease the pressure of monetary policy. But other policies need to step in.
Yes, thank you. Olli.
I think there are, I look forward, I look to the future, so we will have our next strategy review or strategy assessment, whatever one wants to call it, next year, 2025. And I believe that we have plenty of lessons to be learned from the recent crisis and crisis policy measures. And I'll just make 2 points on that. First, in my view, the revised inflation target, that is the symmetric 2% point target in the medium term, has served us well so far. I wouldn't touch that, I wouldn't reconsider that. But there are several elements like geopolitics and supply-side shocks or supply-demand shocks, because the line is not very clear often. And second, the labor market and its surprising behavior or exceptional behavior. In the labor market, I think there have been many changes which we have to study very carefully, and it's actually a very fascinating field in many ways. Just mention one or two. One is the labor market reforms in many countries that have changed the European labor market, and the other thing is immigration. In the US, immigration has had a very significant impact on the Phillips curve and on the functioning of the labor market in the economy. In Europe as well, but we are more heterogeneous. We are seeing a very big increase of immigration in countries like, Lithuania, all the Baltic countries, Finland, Germany, 4 million immigrants since 2015. Population is 84 million instead of 80 million. Portugal, Spain, for them Latin America is basically a labor market reserve, and there's been very significant immigration. So we have to study this carefully and analyze how these real economy factors are changing the operating environment of monetary policy.
Thank you to all for your comments. I have actually many other questions I have prepared. I didn't realize you might have so many things to say, but I think it's fair to also turn to the audience and give a chance for some questions. I hope I'm right that we actually have more time than I see here on the 4 minutes, but now I can see first Urmas Varblane, then Andres. Please introduce yourself also once you get the microphone, and then ask the question.
Urmas Varblane, Tartu University. And I would like to ask about military expenditures, because there is no talk about that at all. Governments in Europe are all committed to increase rapidly military expenditures. And my question is, can you a bit elaborate what could be the short and medium-term lessons after that? Because I even ask like that. What do you recommend to governments? How they should increase military expenditures on the same time to meet Maastricht criteria and not to increase debt level? How to fulfill that task?
Productivity.
I'm glad we're not governments but central bankers, but any of us wants to take that? Olli.
I can start, yeah. First, concerning Finland, we are at or above 2%, and we are now investing in F-35s, which mean that we will maintain clearly higher level than 2%, and we accommodate that as part of our normal budget. One factor which is kind of a hidden secret in the Finnish economy is that we use cheap labor in a sense that military service is not fully accounted because the alternative costs are not taken into account. You have 75% of the male population for every generation in military service, and that's not in a way accounted to national accounts fully. The economists understand very well what I mean. It's not internalized in the GDP. But as regards how do you, I think that's a very relevant question, and for the whole of Europe, and that's why it's very important that we enhance our capacity of working together in setting up and improving productivity and improving cooperation in defense industries, and that's going to be one of the key tasks of the new Commission, essentially. And as we face fiscal consolidation because of increased public debt and high public deficits, so basically the European route is an important element in this regard, and it should essentially supplement the national decisions. At the same time, I want to underline that maybe not as a central banker, but as a European citizen, that yes, we should all ensure that we have high enough spending on defense, because we are facing existential crisis with Russia's attack on Ukraine, and there is always the risk of escalation of this conflict. And it's not going to be a short-term conflict, it's going to be a long-term confrontation, and we better be prepared for that also in terms of defense and security policy.
Thank you, Olli. Martins.
Olli was very straight to the point. Let me add just two things. Of course, the peace dividend is over, unfortunately, and we would love to invest this money in education, healthcare, productivity, growth, and all the related issues. But life is what it is. I think we should view this. Urmas, thanks for the question, a very good question, but let's not view this as a spending. I would see it very much as an investment, okay? And that again kind of changes the perspective, okay? It's part of the growth going forward, an investment from many angles. One, investment in security, in confidence. If there is no security, there is no confidence, there is lack of consumption, there is lack of investment going forward. So it is an important basis for economic growth through confidence as well, but also through industrial activity. We see that industry in Europe is very weak compared to the services sector, so that's one way of reinvigorating industry, and we do need that. So let me touch upon the last point as well. One is what we spend on our defense, but of course we are still to help Ukraine in its effort to fight for their independence and defend also our interests and democracy in the Western world. So we are using, as the Western countries currently, the proceeds from the Russian frozen assets. I think that's a very appropriate choice. We'll see how do we go forward. The war is going to be lengthy, so at some point this money is unlikely to be enough. And then we will need to see a choice of whether do we tax our population or do we take the aggressor's money. That is a kind of issue of lawyers, that's an issue of politicians, but we will face this, if I may say, in economics language, fork, okay? Do you go this way or that way? Mm-hmm. In my view, it's a no-brainer, okay? It's an easy answer.
Yeah, thank you, Martin. Also, Gediminas, you have.
My reaction will be quick. Being from this part of the world, as we are here, I think we all understand that this is not an option. This is a must. This is life. And is then, actually, not a question to the central bank as to what level, but definitely much higher levels than countries have spent so far. And this is also the issue, how to finance the increased defense spending, also in Lithuania, and quite heated debate. And we, as a central bank, being also an expert institution in economics, we also issued our position, position as a help to the government, what they could start or where they could be looking for finances. And actually, the position was that as this is quite a substantial increase in defense spending, and the defense spending are of different character. Some of them resembles more, in a way, investments into infrastructure. So one shouldn't be afraid of increasing, to some extent, even the debt level, because the debt level in the Baltic states generally are quite low in comparison to other countries. But I would say the nail of our proposal was that it's always, in a way, you always try to weigh what are your priorities at a certain particular point in time. And actually, I think this applies to all these states. There are so many tax exemptions. So when you have, on one hand, a must to increase the spending, and on the other hand, you have tax exemptions for various groups of society, you need to assess once again if these tax exemptions in this current particular environment are applicable. I understand this was it's much easier to say than to do, but I think this is one of the possible avenues to answer your question, how finance it.
That's a good point. Isabel.
Yeah, so I think we can very easily agree on the priorities, but we are not the ones, of course, who are taking the decisions on that. I must say, So I'm a bit skeptical about the view that this can easily be financed via public debt. I mean, what we're talking about is not like a one-time increase in defense spending. We are talking about a permanent increase in defense spending. And honestly, I cannot see how governments can get around having that as part of their normal budget, which means they will have to raise revenues for that. So I cannot see how the debt financing can solve the issue over the longer run, because this will be permanently higher. And I'm not saying that at a specific point in time when there's a specific need, it cannot be financed via debt. Of course it could, but there has to be a longer-term plan, and then it has to be part of the normal.
I agree. That is very much the debate that we're having actually right now in Estonia. But
I need to add on to my speech, because I saw the reaction by Isabel's probably. I meant only that a certain part of it, which resembles like investments into infrastructure. Of course, the permanent nature of spending needs to be financed by the permanent income, or public income. So that's for sure, and that's what's happening in my country too. They increase the taxes and etc. etc.
Thank you all for your views on that question. We have another question from Andres.
Yeah, thank you, Andres, member of parliament, member of supervisory council of Eesti Pank, formerly deputy governor here as well. 2 quick comments, 1 question. First comment on energy dependency. Estonia's energy dependency directly from Russia has always, for most of the time, been non-existent, even before February. Indirectly, obviously, and that's how we got the collateral damage impact, was Europe's dependence on Russian pipeline gas. So, but that is fixed for now, just sort of to be factually correct. It's also a question of energy market design. I think that is something what is worth looking into as well, because these markets are really shallow, and it's not always that underlying commodity really reflects, or fundamentals reflects the price of energy. My second comment is on competitiveness, and it's worth to look on a longer time series. Back in 2011, US and EU as economies were equal. In dollars or euros, doesn't matter. Fast forward 12 years, US economy has grown in nominal terms 74%, Euro area 13%, EU about 15%, and just for the record, Estonia 75%. But this is a good reason to look into why, and in more granular way, what has made this difference, because we see not an incremental changes in competitiveness, but a disruptive change caused by the technology. And that is completely different ballgame. And now my question, you all spoke about inflation in services sector, but services is a very wide spectrum. So I would like to see, so what is really driving? Is it hospitality industry, hairdressers, professional services, telcos? If you say me a headline, services inflation, yes, that is interesting, but what is driving services inflation within services? Thank you.
Thank you, Andres. Isabel, you want?
Yeah, so it's actually, it's very broad-based. So if you look into different categories, you see that it's not driven by like 1 or 2 specific categories. I mean, you mentioned, of course, some of them. I mean, hospitality certainly played a very important role, but we also see that these market services, they have actually had a very high inflation. So it's very broad-based, and I also had this one chart which showed that, I mean, kind of the common narrative is it's all about wages. But it's not only wages, it's going beyond that. So it's relatively broad-based. It's not, you cannot pin it down and say it's just this one thing.
It's the consumer and the money supply, demand, basically. So that's why it's broad-based. I would very much agree with Isabel. And but we are seeing now certain rotation, even though it's perhaps slower than one might expect from, say, services to goods, because goods inflation is lower, service inflation higher, so the relative prices are doing their job, but it is a slow process in any case.
Yeah. And thank you for your comments, Andres. I think if we're very quick with our responses, we can have 2 more questions at least. Please, Ricardo.
Thanks. I'm Ricardo Vicente from Bank of Estonia. Isabel Schnabel, I believe you are either the creator or at least one of the early adopters of the neologisms greenflation, climateflation, and fossilflation. So these are forces that have an impact on price stability. And we know also that physical climate risks, they have increased in terms of intensity and frequency. We know that companies, they are adopting their technologies, they are becoming greener. And these are all shocks. These are all shocks to prices, shocks to the macroeconomy. And usually, we think about shocks as either on demand, on supply, they are permanent or temporary, and they might be to the level of GDP or to the potential level. So my question is, these types of shocks that relate to climate policy and climate risks, is there something particular to them that they create some specificity in terms of the pursuit of monetary policy, or can we just classify them as simple as they are either temporary, permanent, to the level or to potential? Is there anything specially about them for the pursuit of price stability? Thank you.
So thank you very much for that question. Olli already mentioned that in our review of the monetary policy strategy, we are also going to look at this whole question of what will future shocks look like. And obviously, shocks stemming from climate change will play a major role going forward, and I think we are all aware of that this is no longer kind of something that happens in the far future, but we are basically seeing it more or less every day somewhere. And so we typically think about these shocks in our normal classification as adverse supply-side shocks. But I think it could be worthwhile to look into this in order to see whether there is something more specific about it. I would normally say, okay, it's similar to an adverse supply-side shock. This is one of the reasons why many of us expect that in the future there will be more adverse supply-side shocks, and it's a big question for monetary policy how we deal with that. Because I think one thing we've learned over the past high inflation episode is that kind of this textbook prescription that you can look through the supply side shocks, especially if they are transitory, has to be questioned. And so one of the big questions is going to be, how is monetary policy going to deal with these type of shocks? And I don't think I have the good answer to that yet, but this is something that we need to think about. What is clear is that what was mentioned already many times in my speech, but also in the discussion, that in such an environment, the anchoring of inflation expectations becomes all the more important.
Thank you, Isabel. Do we have another question from the audience? Peter.
Yeah. Thank you for a very good lecture and also for the discussion. Peter Luikmann from Bank of Estonia as an economist. I think we always, as central bankers, we ask of politicians to be sensible and, of course, target some kind of sustainability in the fiscal policy. But isn't it the most inconvenient way if usually the first thing which pops to the mind of fiscal authority is to hike the VAT rate, which transmits to inflation usually at the worst possible timing? By the way, greetings to Finland. You have a VAT hike this weekend. But would it be also the question that we should be more, at least vocal, about the ways how this fiscal sustainability can be achieved? Of course, cost cutting works very good in our aims, but not that well in our results. So is it always the case that fiscal sustainability, of course, is a part of democratic processes, but somehow for the technology and technicians of the central bank should be achieved at some point of time more in terms of one tax increases and one other point of time by other tax increases? Is it always that random? Like it turns out, or should we be more specific how they should achieve it.
So the question is, I understand, if we should give more advice to politicians in terms of what kind of an impact a particular tax increase
Yes, because
would
they
have.
always lost in between elections.
So, and the context is that we do have also indirect taxes going up, also actually income tax, but Olli, you have a view on that?
Thanks, Peter. I think it's a very important question, and it has at least two aspects, or the answer should have two aspects. One is that we have differences between countries to some extent, how much it is, say, considered legitimate that the central bank intervenes in the public debate or government's decisions on fiscal policy. For instance, I'm going next Tuesday to the budget negotiation opening seminar of the Finnish government. It's going to be Tuesday, Wednesday, their discussions, and then they will conclude it on Wednesday. I will pass my message, but I will not go in specifics of concrete measures because I think that that is part of the democratic mandate of the government and the parliament. So we have to also, when we call for central bank independence, we have to also ensure that the democratic decision makers have their mandate in the field of fiscal policy. Having said that, in my view, if you talk about monetary fiscal interaction, so independence does not mean isolation. I mean, it's good that you have at least dialogue, if not coordination. It's usually much better if fiscal policy and monetary policy work to the same direction. That's very relevant for the overall outcome of economic policies. The second point is that there is plenty of academic research on what is the optimal way of fiscal consolidation. And without going into nitty-gritty on that, for instance, the OECD used to have a kind of scientific conclusion -- rule of thumb that usually, on average, a meaningful way of fiscal consolidation is 2/3 expenditure cuts, 1/3 tax increases. Of course, that's always context-specific. As you refer to Finland, I understand the government decision on increasing the VAT now because they needed short-term measures to increase revenues. And this 1.5% increase will bring a significant improvement or certain improvement of public finances. But at the same time, it's essential that there will be more permanent measures on the expenditure side. And this is now the key issue next week, Tuesday and Wednesday, in the budget negotiations. And I wish the Finnish government the best of success in that, of course.
So do we. But Martins, you want to add to that?
On this one, of course, this is a tricky issue, Peter. But I think just one more point to what Olli very eloquently kind of laid out. Of course, we are in the same boat. We talk, we help, we let our views known, okay? But we are democratic nations with democratic institutions, with specific mandates of what the institutions must deliver, okay? I think this is extremely important. But also it's an issue of reputation, okay? You build your reputation if you can deliver, okay? And for monetary policymakers, there is no way to deliver anything on tax policy. We can come out with suggestions, but we are not the ones who put it into laws. We are not the ones who implement and enforce. So there is no way for us to ensure that the policies are delivered.
And we are not usually the ones who are responding to the citizens in the marketplace or in the town hall meetings.
Exactly.
Apart from this town hall meetings.
So we, in the Latvian case, we do the best to help, and we will always help, but this is not our business.
Yes, thank you. Thank you to both of you. I think you put it very well. We are trying to do the same at Eesti Pank, being helpful as advisors on economic policy, but of course also understanding that there's a line beyond what we should not go. Looking at the clock, it seems unfortunately that the remaining 10 or so questions I have to ask you later, privately still. But I think we still had a good,
Can I say just one more thing?
Very briefly.
Just to build on this strategy review, which I think is going to be a very critical moment going forward. I'm happy with what my colleague said in terms of the target and able to deliver the target, all that kind of thing. But of course, we will need to look into the experiences of the recent years. And one of those is negative rates, QE, and all the related elements. And I think we've learned that we need to be active to help the economy, but I think the central banks also should be mindful of their footprint and leave when necessary. So the instruments like QE and QT should be made much more automatic. We come in, we help, and we leave. Okay? We don't remain in the marketplace for too long. Thank you.
They should be maintained in the toolbox, nevertheless.
Sure, of course.
Yes, that's an important thing. We didn't really get into all the lessons learned, but Isabel maybe very shortly.
Yeah, also I wanted to make one last comment, not about the review, but so as central bankers, we always look at inflation. So, we saw inflation shooting up, and then now we see it's coming down, and that makes us very happy when it comes down. But I think we have to recognize that for the regular people, they don't really care about inflation, but they care about prices. And we have to be aware that even if inflation has come down, prices may still stay high, and especially if wages have not caught up. I mean, that raises substantial issues, and that is something that I think we also have to keep in mind, even though we are, of course, focused primarily on inflation.
Yes, that's an important point.
The citizens care about prices and interest rates.
Yeah.
Yes.
And
there's an interaction.
And as you can see, we don't want to leave. Okay.
Yes.
But I think that again kind of brings back kind of to the whole mix of policies is that of course we can ensure that inflation is low through our instruments, but income growth and productivity growth, which is about the price level, which is about prices and well-being of the societies, other policies are in bad need to chip in.
It's a very nice PhD seminar. So it's,
you can see we would like to tell you so much more.
Yes.
But unfortunately, I have to thank you, Isabel, Olli, Martins, Gediminas, for all your comments. I think you were able to lay a good ground in terms of also what are the challenges going forward, not only for central bankers, but also for governments and policymakers more broadly. And I thank you very much for coming to Tallinn, and thank you everyone in the audience also for listening and paying attention and asking questions. Thank you.